Latest figures from the Bureau of Statistics have confirmed perceptions that there's a widespread herd rebuilding program taking place throughout Australia. Record rainfall through 2011 and a good start to this year is underpinning a pickup in branding rates, and abattoir figures are reinforcing a view we are heading for a national herd of 30 million head by the end of June. From March last year to February this year, female cattle processed nationally reached 3,143,000. That's 375,000 fewer than the corresponding period 2010-2011. And the state numbers tell the real story. Every state is down on 10-11, with Queensland, the beef state, leading the way, and even preliminary figures for March indicate that this trend is continuing. So 30 million cattle for Australia by the end of June. The previous highest number I can find was in 1976, when the figure was 29.6 million. Ominously, that of course preceded the great beef cattle price crash of the late 70s. Contrast our numbers with the United States, where the herd liquidation continues. The latest figures puts the number of American cattle at about 90 million. That's the lowest since 1952. And last week at our sale yards, it was again a numbers game with a significantly weaker trend brought on by a massive lift in offerings. An example was the 9,300 head offered at Roma on Tuesday. Nationally, yardings were up 84% on the previous week to the second largest ever weekly total. So prices dipped through the categories. Most markets expected a bit of a slide, perhaps not that much. The interest will be on how prices move in the next full week of trading, given that this week will be shortened by the Anzac Day holiday. And the big numbers weighed heavily on the Eastern Young Cattle Indicator, which dumped 5% to close at its lowest point this year. The live trade out of the north remains pretty busy. The big ship Ocean Drover left Darwin on Thursday for Indonesia with 20,000 head. Prices have edged down a fraction. Steers ex-Dow are now $1.80 and heifers are at $1.65 a kilogram. Lamb and sheep numbers were also way up last week and buyers sat on their hands. The National Livestock Reporting Service says supplies lifted 56% and competitive bidding was virtually restricted to young ewes. That's the biggest weekly price dump I can recall for lambs, and mutton followed the trend. To grains now, and a slight rally failed to cover the overall fall of around 10% in the Chicago pits so far this month. American exports were also down last week, and once again the underlying fear across equity and commodity markets appears to be sovereign debt. So the numbers all headed south. The soybean price is okay compared to last year, but both wheat and corn are down about $1.60 a bushel on this week in 2011. Local wheat futures fell in sympathy with the Chicago trend. The major concern about the coming winter crop remains in the west, where a lot of wheat country is absolutely desperate for rain. New crop spot prices softened as well. Wheat dropped $9. Canola is firm and sorghum is back close to its lowest price for several years. To New York now for the soft commodities, where both cotton and sugar appear to have some fragility about them at present. World cotton stocks are said to be massive, and without weather issues, our prices will come under a lot of pressure. And a sugar report suggests slowing demand from China and a build-up in world supplies will see sugar prices fall this year by around 5 cents a pound. Cotton eased a fraction last week, while sugar moved away from its recent trading patterns to finish close to 22 cents. Finally, to wool, where forecasts about a price dive for last week were proven correct. On the back of a very big offering and subdued buying from China, the market shed more than 2% across the microns. Pass-in rates were well above average, with the finer wool suffering most. The Eastern Market Indicator fell 2.2% to close at 1,165 cents a kilo. That's 160 cents less than this week last year. And that's the Landline check on prices.